This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. Well, we're 10 weeks into 2026, and the stock market is basically flat. The S&P 500 is down just 1%, which might seem calm until you look at what's actually happened this year. A Venezuelan president was captured, the Supreme Court struck down tariffs, war broke out with Iran, and oil prices surged more than 50%. So why hasn't the market panicked? And what are investors actually watching right now? The biggest economic shock so far this year has been oil. After the US and Israel launched strikes on Iran, shipping traffic through the Strait of Hormuz stopped. That's a huge problem because about a quarter of the world's oil supply passes through that narrow waterway. When the conflict started, oil prices quickly jumped more than 50%. And higher oil prices can ripple through the entire economy. They raise the cost of transportation, manufacturing, and shipping, which eventually pushes inflation higher. Another major economic development came from the Supreme Court. The court ruled that the administration did not have the authority to impose certain tariffs under emergency powers. As a result, the government replaced them with a smaller 10% global tariff. For the average household, that cuts the estimated cost of tariffs roughly in half, saving about $700 per year. Lower tariffs could help ease inflation later in the year. Despite the geopolitical drama, investors are mostly focused on two big financial questions. First is private credit. While some of the biggest firms in that industry, like Apollo, KKR, and Blue Owl, have fallen between 25 and 35% this year. Second is artificial intelligence. AI has created huge excitement, but investors are starting to question how quickly those investments will actually pay off. Technology stocks tied to software are down almost 20% this year. Even with all this uncertainty, the stock market has held up surprisingly well. In fact, some sectors are thriving. Energy stocks are up 26% this year. Consumer staples, companies that sell basic goods like food and beverages, are up around 10%. Industrials, materials, and utilities are also doing well. These sectors tend to perform better during uncertain times. But the real reason markets remain stable is simple. Investors are focused on corporate earnings. Right now, analysts expect the S&P 500 companies to earn about $310 per share in 2026. That would represent roughly 17% growth compared to last year. If companies deliver those profits, the market could still end the year with solid gains, which is why investors try to look past political headlines. Historically, geopolitical events feel huge in the moment, but their long-term impact on markets is often limited. There is one geopolitical risk that would be very different. That's Taiwan. Oil powered the global economy for most of the 20th century, but today advanced semiconductors are just as important as oil was. They power artificial intelligence, smartphones, cars, and military systems. Taiwan produces more than 60% of the world's semiconductors and over 90% of the most advanced chips. The United States currently produces none of the advanced chips. So while markets have taken most geopolitical events in stride so far this year, a disruption in Taiwan would be a completely different kind of shock. So far in 2026, the global economy has faced oil shocks, trade disputes, war in the Middle East, and uncertainty around AI. Yet markets remain focused on the fundamentals, growth and corporate profits. Because in the long run, earnings still drive the market. But investors are watching carefully because while oil shaped the economy of the past, the next economic battleground may revolve around semiconductors. And the hope is that we can produce 14% of the advanced chips by 2032. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching. Thank you.